of the reasons there could be some nervousness surrounding tomorrow's release of the PPI. We're going to get that tomorrow morning before we get day 2 up on Capitol Hill. And the producer prices have been coming in a lot hotter than consumer prices. Of course, the producer prices are also going to benefit from the drop in oil prices that we had last month, which is pretty much being undone this month. So again, I don't know why the markets would pay attention to such backward-looking data that is really irrelevant, but that's what they do. And this is how these algorithms are programmed, and they trade off the numbers. I just think that people should take advantage of any of these moves. In fact, when people believe that inflation, higher inflation, is bad for gold, when in fact gold is an inflation hedge, and the more inflation we have, the more you need to hedge yourself, should take advantage of this misguided idea that higher inflation is somehow bad for gold because it means the Fed has to fight harder to bring inflation down. What it really proves is that the Fed can't bring inflation down. It doesn't have the wherewithal or the ability to do it because of all the other problems that would be exposed if the Fed were to do that. And that kind of brings me to the discussion of today's hearing before Congress. And what's the most frustrating part, of course, about the entire hearing is that they're there to discuss inflation. And nobody, except maybe Walsh, but he doesn't want to let the cat out of the bag, but the entire discussion centers around a term that nobody properly defines. Everybody acts as if inflation is rising prices. And it's not. I've talked about it on this podcast many times. Inflation is an expansion of the supply of money and credit. That is what is being inflated. You can't inflate a price, you inflate money supply, because inflate means to expand. And if you're going to have a discussion about inflation, but you're misdefining what the term means, then your whole discussion is meaningless. Because prices go up, prices go down. Inflation is a whole different problem that causes the general price level to be higher than what it otherwise would have been absent the inflation. It doesn't even mean that prices go up. It can simply mean that inflation prevented prices from going down. Now, again, the government tries to tell us that prices going down would be horrible. How would it be horrible? Especially when so many people are suffering from high prices. Look how much food prices have gone up over the past several years. Would it be such a disaster if they came down? Of course not. I mean, why do they have to keep going up? If the problem is food prices are too high, having a target of, well, let's have them go up another 2% a year, that doesn't solve the problem of prices being too high. That makes them higher. What would solve the problem is if prices actually came down. And that would solve a lot of problems. Consumers want the price of everything to go down. Yet, according to the government, that would be a disaster. The government is there to make sure that prices don't go down, to save us from the pain of being able to buy stuff for less, right? This is what the government is selling us on. So that's the biggest problem is a misunderstanding of the term. But then the other thing that really frustrates me always about these hearings is that you've got all these congressmen and women, right, that are upset about inflation, and they're asking the Fed, what are you going to do about it? What's your plan? How are you going to stop this inflation? Meanwhile, they are part of the reason that we have inflation. It takes two to do the inflation tango. Congress has to spend money it doesn't have. It has to have deficits. And then the Fed monetizes those deficits. And the Fed artificially suppresses interest rates in large part to make it possible for the government to finance those deficits without having a crowding out effect on private credit and pushing up interest rates. So it is the Congress, and of course the president, because he's signing on to all this spending, and the Fed. It's a combination of monetary and fiscal policy working hand in glove. That is why there is inflation. Yet the very congressmen and women that are voting for the deficit spending that is ultimately the source of the Fed, of the inflation that the Fed creates, they're there yelling at the Fed as if they have nothing to do with it. They need to look in the mirror and recognize their own responsibility. And then, of course, the Fed chairs, they always deny their responsibility. They want to blame tariffs. They want to blame the war. They want to come up with all kinds of excuses about where inflation is coming from. The cause of inflation is right there in that hearing. It is being caused by all the representatives and the Fed. They're there discussing a problem that they've created, and they're pretending that there's some exogenous solution. And then when Warsh talks about how, we're going to do things differently, we're going to solve the problem, without actually getting into what would need to be done to solve the problem, which is why they're not going to solve the problem. Anyway, we got a quick commercial break, so stick around. As soon as we come back, I'm going to get into the hearing and the Q&A.
Talk to any manufacturer in this country right now, and you'll hear the same thing. The pressure is coming from every direction. Rising energy costs, a tight labor market, supply chains that are still fragile, and cyber threats that get worse every quarter. This isn't one problem you can solve and move on. Rockwell Automation just put out their 11th annual State of Smart Manufacturing report. They surveyed over 1,500 decision makers across 17 countries, and what they found is exactly what you'd expect if you've been paying attention. 90% of manufacturers say digital transformation isn't optional anymore. It's the price of staying competitive. But here's where it gets interesting. Only 43% of the data these companies collect is actually being used. The rest just sits there. That's enormous value left on the table. And nearly half of them, 46%, were hit by a cyber incident in just the past year. As factories get more connected, that risk lands directly on the balance sheet. If you run a manufacturing business or you invest in one, this report is worth your time. Download it for free at rok.auto/SOSM. That's rok.auto/SOSM.
All right. So the first thing that Chair Warsh said that really caught my attention was when he talked about how many people work at the Federal Reserve. I mean, I never really thought about how many people work there. I had no idea it was 23,000. The Federal Reserve employs 23,000 people. What the hell do these 23,000 people do? Why do we need 23,000 people to set interest rates? I mean, one person should be able to do it. There's 13 members of the FOMC that vote. I don't know where all these people are coming from. First of all, the Fed shouldn't even be involved in setting interest rates. The free market should do that. So we don't really need any employees. But 23,000 people at the Fed? I mean, talk about inflation, right? We've had an inflation in the number of people who work at the Fed. When the Federal Reserve first opened its doors for business, it was November 2nd, 1914. I looked this up. I mean, I knew that the Federal Reserve Act was passed in 1913, like the income tax, right? It was a horrible year for America. It was a twofer because we got the income tax and the Federal Reserve during the same year. So, 1913 is probably the worst year in U.S. history as far as bad legislation. But I looked it up. The Fed didn't start its operations until the following year, right? Because they had to set it up. Once the Federal Reserve Act authorized the creation of the Fed, they had to set it up. So they opened for business November 2nd, 1914. On that day, they had 40 employees. That's it.